created a kind of a sequence or a kind of a momentum. Pratik spoke about X factor. Shankar spoke about the low volatility. Now there is one more factor which we're gonna talk about today. And I'll invite Tushit Thakkar to come over and talk about it. That's nothing but momentum. So Tushit is a quant analyst for PMS and AI schemes at Motilal Oswal Asset Management. He is primarily responsible for research on factors and systematic quants at the firm. He has experience in capital markets ranging from research to construction to management of varied investment strategies. Previously, he worked with ICICI Pro AMC as a product specialist as well, and also worked with MSCI for creating these indices and managing portfolio across ESG, factor, and thematic strategies. Tushit holds Masters in Economics and Bachelor degree in Electronic and Instruments from University of BITS Pilani. In addition, he is a CFA and FRM and also pursuing Chartered Alternate Investment Analyst US currently. So I'd like to invite Tushit to talk about the momentum so far what you have created to continue momentum.
Good evening. I hope I'm audible. Can you give me a thumbs up? Yeah. So thank you. I hope you're having a good time. I hope you're learning something different. We'll be moving from risk minimization to return maximization type of strategy, correct? So we're talking about momentum. A lot of people today are quite interested. There are a lot of momentum options that are also out there, correct? So we'll talk about this particular factor. What is momentum, correct? When we talk about momentum, if you look at the history, starts with Isaac Newton, correct? So Newton came up with this first law of motion, correct? What does it say? The basic principle and ideology is something which is stationary until a force is applied. And something which keeps on moving will keep on moving until an opposite force is applied, correct? So if we apply this same principle in investing as well, the idea is very simple. A stock which is stationary for a quite bit of time, until and unless an external pressure or some positive news is applied, it doesn't move. And a stock which keeps on generating returns over the past has this tendency to keep generating returns in the future until a negative force comes up, correct? So that's the basic simple idea. Just like momentum can be applied in physics, it can be applied in, as I said, investing, it can be applied in sports. We say that a current batsman is in form. We say that a current actor is in form, correct? We expect him or her to give consecutive hits. Right? So that's the simple idea of momentum. And this idea exists from the 1800s. Correct? So if you've heard about David Ricardo, correct, who's an economist, he came up with this idea where he said that you need to cut your losses or losers first, correct, and shorten them, and you need to ride your winners for a long period of time, correct? So that's the principle. From 1700s, 1800s, we have had this principle of momentum. So even though we have this theory from a long period of time, correct, is it easy to apply this in real life, correct? And it's really actually very difficult. If you look at Newton himself, who came up with the idea of momentum, he couldn't apply momentum in his investing philosophy, correct? So you look at how Newton had invested. This is during the South Sea bubble stock, correct? So Newton started investing, correct, and suddenly saw a lot of portfolio value during his investment success, correct? And then he started cutting out his winners very quickly. And then he saw his friends getting rich, getting happy, correct? So there was this herding behavior. Newton again re-entered, and then finally market corrected, correct? So instead of losing or cutting down your losers, Newton held on to them for a long period of time and finally exited being broke, correct? So a person who came up with this idea of momentum, correct, couldn't apply the same principles in his own investing philosophy, correct? And that is why we need systematic strategies or factors like these, correct, to take advantage of these behavioral biases that we have, And these biases can happen, these biases occur in each and every person, correct? Be it Newton, be it any fund manager out there, be it any normal person that is out here, correct? Every one of us have these biases. So that is basically the momentum factor, correct? It is the tendency of winning stocks which continue to perform well in the near-term future, and on the contrary, the losing stocks which keep on losing in the near future, correct? And the simple strategy could be very easy, something like using a 6-month or 12-month return, correct? So if you look at the past, as of today, if I look at the 12-month returns, past returns of all the stocks, and I select the top 30 stocks, correct, which have the highest return, and I hold on to them, that is nothing but a simple momentum strategy. So what is the basis of this? Correct, in Gujarati, we say, or have this concept called Bhav Bhagwan Chhe. So for momentum, everything is decided by price. Price decides what comes in, price decides what comes out, correct, goes out. And the principle here is not buy low and sell high, because no one knows where the low is here, correct? So what momentum strategy does, it waits for the stock to rebound, correct, looks for trend in the market, holds on to them when the trend solidifies, and starts selling when the market starts trending downwards. That's the simple idea of momentum, correct? Why does this momentum strategy work? The idea is very simple, correct? So when you have an external catalyst, correct, which improves, say for example in this case, the value of the overall stock, initially there is an underreaction to that stock because we have a status quo bias. Jo jaisa chal raha hai, waisa chal raha hai. That's the idea, correct? So if you look at, even if you look at the COVID period, correct? After COVID, we all knew that demand for IT services is going to increase. But what we were looking for Infosys and the TCS of the world. Correct? We are not focusing on those particular segments, say for example the mid-cap IT segment, correct? So Tata Elxsi, Mindtree type of stocks, correct? And they were actually picking up momentum at that point of time, correct? So the idea here was that even if you pick those winners, correct, at a later stage, correct? Say for example, during the July phase to the December 2020 type of period, these type of stocks gave almost 100 to 120% returns. Right? So you would think that these type of stocks have already given their returns. The analysts were predicting that their EPS margins are going to be relatively quite high. The benchmarks were already set very high. But these type of companies again kept on beating the estimates quarter after quarter. And even in the year 2021, they gave a return of almost 200% or so. Correct? So that's the idea of momentum. Correct? There's this initial status quo bias. Correct? There's this underreaction that we have. Slowly and steadily the trend picks up. Correct? Then there is this herding that comes up, overconfidence that is there, and the trend keeps on sustaining. The idea of momentum strategy is to capture this trend in a systematic way. Correct? Just like a pendulum whose valuation keeps swaying from left to right. Correct? The idea here is to capture these overreactions and underreactions in a strategy. And that is why Eugene Fama and Ken French, correct? So Fama and French, who are quite well known in the field of factor investing, call this the greatest anomaly of all times. And this, again, principle of riding this momentum, correct, and this sector rotation that keeps on happening or picking up these sectors can be seen in this particular slide. Correct? So if you look at from an historical perspective as well, you look at IT, correct, your allocation to IT steadily has increased over the last few quarters. Look at the initial phases, correct, your exposure to defensive was relatively high, correct, during the COVID period. Before that, you would look at your exposure to financial services was relatively lower just because we came out of the NBFC crisis, correct? And steadily and slowly as the NBFC segment and the banking sector picked up, correct, your allocation in momentum kept on increasing. So this is actually a very good strategy and an excellent strategy for someone who is looking for a more active type of portfolio, someone who's more seasoned, someone who wants to capture those trends and wants to be more agile in terms of their allocation, correct? That's the idea. And the interesting thing is that this type of strategy works everywhere, correct? So momentum works across different markets, be it the United States, be it globally, be it in Europe, be it in India. It works across different asset classes, works in equity, works in bonds, works superbly in commodities and currencies, and also works across different time periods. Correct? So you can pick up short-term momentum, you can pick up long-term momentum, matters on how you want to develop your strategy. Correct? So that's the overall idea of momentum. Now, coming from momentum to how this strategy has relatively performed, and just a brief snapshot, correct, of what you would have expected if you have been in momentum, or if you have been tracking momentum from some time, right? And if you see here, unlike the low vol strategy, here the risk is relatively on the higher side, correct? But you are getting more than compensated for that by the amount of returns that are there in the portfolio, correct? So instead of 22% of risk that Nifty has, the momentum portfolio would have a close to 23-24% type of a standard deviation, correct? But at the same time, if you look at the returns are significantly higher than what Nifty has given. So it's a relatively more risky solution, but you're getting more compensation for the risk you're taking, because as you can see here, your risk-adjusted returns are looking quite better, correct? So as Shankar pointed out, one of the best ways to look at or understand the strategy is how much returns are you generating for the risk that you are taking, correct? And this is where momentum type of strategy shines out. You look at any particular time frame, your risk-adjusted returns are looking quite beautiful. If you dissect this performance into market cycles, correct? And as you said, low vol was a type of strategy that worked perfectly in a bear market. Momentum is a type of strategy that works very well in a bull market, correct? So during a bull market, there is this sustained trend that is there in the market, and what momentum does is capture this particular trend, correct? It may lag during a bear market, it may actually lag quite significantly during a recovery, correct? But it is during the bull markets that these type of strategies really shine. So for someone who is trying to time the market, I may say, or he or she believes that I can perfectly time the market, these type of strategies work well if you think that there's a bull market that is going to happen over the next couple of years. But instead, if you're someone who believes that time in the market is more important than timing in the market, correct? Then from a long-term perspective, pick it 3 years, 5 years, 7-year time, 10-year type of rolling time frame, and you'll see that your odds of outperformance keeps on increasing. Correct? So for someone who wants to have a more interesting flavor of equities, correct, wants to generate more returns from a longer time frame, these type of strategies relatively make sense. Again, the same idea on a rolling return basis, correct? If you see it, the idea is just here to show that there's more consistency in terms of performance, be it returns more than 10%, 15% or 20%, correct? So if you're looking for more consistency, you should come from a longer time frame, something around 3 years to 5 years type of time frame. So finally, why should you invest in momentum? First, as I pointed out, takes advantage of the investor's behavior that is out there, correct? In a more systematic way. We have these biases, we take advantage of these biases through this simple strategy. Second, it works across market cap, sector, time period, correct? So you don't have to think about which sector I want to allocate, someone who is looking for a more tactical allocation. Correct? You don't need to worry about which market cap segment or sector segment do I want to allocate. Momentum automatically takes care of it. Third, which is a very interesting portion, is that it offers a very unique portfolio exposure. Correct? So you look at your portfolios. You may have large cap funds, you have multi-cap funds, you have value funds, you have AMCs which have quality tilt. But none of these offer you a momentum flavor. Correct? So your portfolios are actually not portfolio factors diversified. Right? You may have some quality flavor, you may have some value funds, you may have size funds, correct? But you don't have momentum in your portfolio. Correct? So this year, what we are trying to do is give you a very simple, easy, cost-effective way of adding momentum flavor into your overall portfolio. The next point is it's nimble and agile. Correct? So as I said, with changing market conditions, these type of portfolios automatically adjust to the market scenarios that are out there and try to capture the trend that is there in the system. And finally, from a long-term perspective, in upward trending markets, there is a potential to outperform. So if you're someone who thinks or believes that the next couple of years are going to be a healthy bull market in the Indian market scenario, then this type of strategy would be a good allocation to your overall basket. So finally, thank you. That's it from my end.
Thank you for keeping it short and yet informative. I think this is the third presentation that these guys are going through, and yet this particular factor is something that generates interest from all kinds of investors and advisors. So just for those who are interested, like I asked earlier, could you break down the mathematics behind capturing the momentum factor?
Sure. So what we do here is, the idea is very simple, correct? So as I said, momentum is basically capturing the trend or returns that are there in the market. So in this particular strategy, what we do is we calculate, say for example, the past 12-month return of all the stocks that are out there. Right? Along with the past 12 months, we also look at the past 6-month returns that are out there, just to check if there is persistence in momentum. Correct? So it may happen that a stock has given returns over the past 6 months, over the initial 6 months, but actually been lagging over the last 6 months. Correct? So we want to check that there is this persistence that is there in the trend. Correct? And we are not catching on to these stocks at the wrong point of time. Correct? That is what we do, and then we adjust them for risk that is there in the system, correct? So as Shankar pointed out, if we are talking about a stock which has gone from 100 to 150, at the same time there's another stock which has gone from 100 to 200, correct? We will adjust them for the volatility that they've gone through. So the volatility measurement is exactly the same, but we adjust these momentum scores for volatility, and we select the top 30 stocks which have the best momentum that is out there. That's the simple strategy.
Great. Thanks for breaking it down. So, like you said, this particular factor captures momentum for the last 6 months and 12 months. And according to historical evidence, stocks that have done well in the past will tend to do well in the future, generally. But that happens till a point. What happens when investors, of course, it's hard to time the market. What happens to those investors who invested at that point and who are worried about that fact, whether if this is the start of a correction or not? So do you think those people should stay away from momentum factor?
So momentum in itself is quite self-adjusting, correct? So if we are talking about the stocks that we are holding on to in our particular portfolio, the next rebalancing they may get out, correct? So if you are selecting 30 stocks, that doesn't mean all the 30 stocks are going to give you performance in the next 6 months. Correct? Here the idea is that very simple, even if, and this is what we have historically seen, this outperformance that we are talking about has come from on average 15 to 17 stocks. But the outperformance that they deliver is so significantly higher than the losses we have in the rest of the portfolio, correct? And they keep on churning out of the portfolio. So these type of strategies, you'll see on average will have relatively higher churn, correct? Every 6 months that we run the strategy again, a significant portion of the stocks which are not doing so well will get out. The stocks which are doing relatively well will get in, correct? So if the trend in the system is changing, if we are seeing a market correction, these type of things will automatically adjust into the momentum. But yes, it can happen that you may catch on to momentum at the wrong point in time, correct? So if you're going through a correction and your momentum strategy rebalances, you may catch on to low beta names, and then while riding out, your portfolio will be low beta and may not give you so much recovery. So these type of whipsaws can happen. Just like with every particular factor strategy, it can happen in this particular case as well. Then that is why we normally say that if you are investing in momentum, be it from a more long-term perspective, be it more tactical, and for people who are actually interested in having some different flavor in the market. That's the overall idea.
Okay. It was interesting to note in the first part when you said that there is quality also built into this. So, right, there is some, because, I'm sorry, low volatility also built into this. So do you think, would you agree that there is also, because of the constant rebalancing that is going on and constant readjustment to the recent winners, there is also quality built into this portfolio?
It actually may not be so true. So correct. So momentum, when we talk about this quality factor, or not quality factor per se, but quality that is there, what we are trying to see is that at the end of the day, momentum is a signal, correct? So we are trying to calculate that signal. What happens with introducing this volatility concept or adjusting them for volatilities, we are trying to reduce noise that is there in the signal. But that does not mean that I'm going to capture or have all those securities in my portfolio which are good quality. Right? You may have, say for example, Adani stocks, correct? And some may believe that those are not good quality. Some may believe they may be good quality, correct? So again, as I said, quality, you may have your own judgment, correct? But it doesn't matter from that perspective. Your portfolio will be relatively very high momentum. They will have good winners, but it doesn't necessarily mean that they may be high quality as well.
Okay, so there's no correlation that you see. Sure. Maybe we'll just have a go at the audience if there is anyone who would like to ask something to Mr. Tushit. I guess the factors are covered in detail in their heads. Yeah, this.
Okay,
We'll
few
come
stocks.
to you. Yes.
Hello. How do you manage drawdown periods? So because investors are restless, so whenever there is a losses, so they try to exit from their portfolio or any investment. So how do you manage drawdowns period?
So as I said, from a risk management perspective, what we try to do is when we are calculating the momentum signal, we try to see that there's more persistence, we try to adjust for volatility, and we have our capping constraints, correct? So from a risk management perspective, we cap each and every stock, and we try to manage risk at that end. But it can happen that all of the stocks, say for example, in the portfolio are going down during a market crash, correct? A crash type of scenario. During those times, it may happen that this strategy will relatively have more drawdowns than your overall basic benchmark, correct? So that can happen, and that is why I said it is not a core allocation in your portfolio. Momentum is more of a satellite allocation, more for seasoned investors, a little bit flavor of additional risk, correct? And as I said, the return that you're getting is for taking that slightly excessive risk that is there in the market. So there may be potential drawdowns, there may be time adjustment during the recovery periods as well, but that is what you're getting compensated by the returns in the long term.
Sorry, you had a question?
Just wanted to know that can you name a few stocks that we can track?
Sure. So you can look at the stocks that are there in our portfolio as well. But if you talk about the overall momentum stocks, we have some Adani names, we have Tata Steel, we have mid-cap IT names, correct? So we have the Tata LXI type of names, IEX is one of those names. So these are all the stocks which have given performance over the past 12 years, over the past 12 months, and are relatively doing good. And there is this persistence that is there in terms of momentum. So these type of stocks will be there in our portfolio, and these will be auto-adjusting. So today you are asking me, this is how the portfolio would look like. If you ask me 6 months down the line, the portfolio could be entirely different, correct? And that is what we have seen in the past as well. So, and that is why I normally don't like to talk about stocks a lot, because the portfolio can keep on churning, and we may get new fresh names and a fresh perspective into the portfolio.
What is the churn like, turn percentage?
Around 100 to 120%.
In a year?
Yeah, in a year.
So if I may ask one more. This is a trend-based strategy. Obviously, it captures on recent trends and, possibly near future trends in the near future. So do you think someone who wants to make higher returns, higher alpha, can look at valuation indicators like PE or something, and then invest in momentum factor based on that, higher allocation when the PE is low and lower allocation PE is high, something like that?
See, you can look at the PE of the momentum as a whole, but I think what happens is that it also changes quite rapidly, correct? So what will happen is, say for example, today we are talking about that a particular couple of sectors, say for example, are very low PE, and we see momentum in them. What will happen is that the next rebalancing, these stocks will get included in the portfolio, and my portfolio PE will automatically go down. Correct. So, and then when they slowly start to pick up, the PE of that portfolio will again keep on going up. So, from a valuation perspective, I don't know if it becomes difficult to track, because your portfolio constituents are changing rapidly as well. Correct. So, it becomes difficult to see.
Market PE. I mean, general market PE, when it's low, then you can have a higher allocation. Then you can invest, and then if you feel market PE is high, you can take out the money. I'm just hypothetically, I'm saying, is it possible?
Yeah. So, if we do a simulation on average, I think it would have made better returns, because you would have expected a bull market over the next couple of years after your PE is relatively on the lower side, correct? So if we see that, then yes, and during those times, momentum as a strategy has relatively done well. So yes, this can be done. The idea with valuation is that it can be a good bottom signal, it can be a very poor top signal, correct? So something that we think is overvalued can keep on staying overvalued and still have momentum within that. So, that is why I say that from a long-term perspective, if you have momentum, it will take care of this automatically and keep on adjusting. If you're coming from that particular view, if you're thinking that this type of timing makes sense to you from a allocation perspective, go ahead, well, do it. It's a good strategy. But for people who don't think that they can time it well, I would think that a 3-year to 5-year and more than that allocation, more than that time frame is a more prudent allocation.
I think someone mentioned, I think Pratik only mentioned that timing a factor is like timing the market. So it doesn't make sense in that way.
Exactly.
So
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.